I am Piers Ridyard, CEO of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, the DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I'm joined by Mark, Head of Research at Bancor. Bancor is the first decentralized trading protocol empowering traders, liquidity providers, and developers to participate in an open marketplace with no barriers to entry. No one needs permission to use the open source Bancor protocol. Mark, thank you so much for coming on the show.
Thank you so much for having me, Chris.
So let's just start with like a basic ELI5. What is Bancor and why should I care?
Yeah, certainly. So when I'm trying to describe Bancor to my peers whom aren't already in DeFi or blockchain in general, what I describe the product as is being very similar to those kinds of online high-interest saving accounts from like the 90s and early 2000s. I think this is a really good parallel because even at that time, the idea of having an online-only bank service was quite confusing, right? That was a huge learning curve for people because, the status quo was that if you have a bank account, there are other services that the bank is going to offer you, things like, checking accounts and checkbooks, ATM cards, and other, banking products. And then companies like ING Direct said, well, actually, we're not going to give you any of those things, but if you put your dollars in our bank account, we'll give you, a 5 or 6% interest rate, while your bank is only giving you a 1% interest rate. And it's a shame that a lot of those banking products proved unsustainable because we can no longer enjoy a 5% interest rate on our money. And in fact, in many places around the world, the interest rate is even turning negative. So Bancor is one of the answers to that. And that is if you have cryptocurrencies, you can put your cryptocurrencies in this product and it will earn interest through the generation of market making fees. So that's really the purpose of it, right? It is a savings, a savings product. It's a way to generate passive income if you have a little bit of capital to sit on.
And what kind of assets can I sort of put into it, and what can I earn as a user?
Yeah, for sure. So obviously, there's our native asset, which is the Bancor Network Token. And that at the moment, because of DeFi being the way it is, you can currently earn approximately 60% a year, which is 60%, yeah. But then we also support a range of other assets. The most popular ones are things like ETH, because we're deployed on the Ethereum blockchain, so its native currency is obviously going to be one of the largest assets that we support. But we also support wrapped Bitcoin, which is just an ERC20 compliant version of Bitcoin. Things like Chainlink, but also the US dollar representations on Ethereum, so USDC, USDT, DAI, and hundreds of other cryptocurrencies. So there really is a very wide range of support for whatever cryptocurrency you happen to hold. And hopefully in the future, we'll also offer staking options or deposit options for things like, the Singapore dollar representation on Ethereum, or the euro, the great, British pound, that sort of thing.
Right. So this is it right now. You can obviously, if you already own cryptocurrencies that are like volatile ones, the traditional ones like Ethereum and Bitcoin, you can make more money by staking these or providing liquidity on the Bancor protocol.
Correct.
But like quite uniquely about Bancor, you don't have to provide two sides, right? Like on Uniswap, if I wanted to be a liquidity provider. Actually, just before we go into that, we should talk about where is this interest rate coming from? Where's the yield? Why can you pay, 5, 6, 7% on USDC? Why can you pay 60% on BNB? Where's that coming from?
Certainly. So yeah, the funds that users provide are used to support market making activities. So the Bancor is not a bank; it is a market maker. And so what that means is that the users' funds are put into these smart contracts called liquidity pools, and that allows market participants to trade against their assets. So, for example, if you're providing Ethereum to one of those pools, the reason why Bancor is able to turn a profit for you is that someone may want to use that Ethereum in order to execute an exchange into another one of the assets on the network. So it's essentially something like a Forex trading desk, but completely automated. And that allows people to transform whatever cryptocurrencies they have into another cryptocurrency that's available on the network. But for doing that, just like you would to a Forex broker, you have to pay the exchange rate plus a fee, right? Plus the broker's fee. And on DeFi, that fee is very small, which is nice because it means that the economy overall is a lot less parasitic than, if you've ever tried to, exchange US dollars for British pounds or something at the airport and found that, they take a massive haircut. We don't do that, but we do take a small haircut. And that haircut is provided entirely back to the people that are providing liquidity. So that's where the profits come from. It's entirely generated in fees. But then on top of that, there is also the bootstrapping, growth phase culture of DeFi, which is what's called liquidity mining or staking rewards. And that's provided in the BNT token, mostly for BNT holders themselves. But we also do incentivize people holding Ethereum, Link, USDC and things too. So they also receive those fees and staking rewards as well for a limited time.
So this is what I love about this generation. Like you guys are interestingly, you guys came from the sort of the 2017 boom era, and I'd love to talk about that sort of process of going through that to now. But that's what I love about this generation of DeFi versus like the previous generations of token marketplaces is that the yield is actually coming from real use cases where you are emulating a lot of what the financial markets already do. Like one of the big things the financial markets do is bridge long-term capital and short-term capital and provide liquidity using the long-term capital to make sure that short-term capital has liquidity. So what you're doing is you're providing an exchange venue where people with Ethereum can trade for USDC or people with USDC can trade for Bitcoin. And that's really useful because people want to be able to do that within the DeFi ecosystem on Ethereum. And so they're willing to pay, some trading fees to be able to move seamlessly between these assets and compose them together with other DeFi. But on the other side, you're taking the long-term liquidity, people who just want to see their assets grow, and you're providing them with this facility to be able to go, okay, cool, I just want to sit on this. But while I'm sitting on it, I don't want it to do nothing. I actually want it to earn return for me. Now, previously, that was restricted to only like hedge funds and pension funds, where pension funds and hedge funds could turn around to investment banks because they were big enough and say, hey, I've got this big old bucket of shares, which I'm not really doing anything with. Hey, Goldman, hey, JP Morgan, would you like to rent these off me? And they go, yeah, sure, we'll rent them off you because then we can go and do things like short sell and things like that on the market. We can go and facilitate the market. But all of this required all of this legal structure, all of these different intermediaries, all of these very like Byzantine processes to do it. So completely unacceptable to the everyday person. And then Bancor comes along and goes, what if we just automated all of that and we allowed this long-term capital to be able to facilitate the marketplace of being able to trade between these assets?
Yeah, that's exactly right. And I think that it's worth pointing out that a lot of that Byzantine policy that's associated with the traditional markets, it is a necessary evil from and is a direct result of its centralization. Right, the whole reason why you need to make sure that these hedge funds and things are behaving in a certain way, or that those activities are supervised, is that if they decided that the market should do something, they actually have a lot of resources to make that happen. So, for example, deliberately depriving the market of liquidity in order to force the price of an asset up, or flushing the market with liquidity so that they have what's called often exit liquidity. In order to force retail investors to kind of weather the the impact of them trying to exit from one of their positions, things like that. And so governments, of course, know that this kind of stuff is happening and make sure that everything is kind of done in as fair a way as possible. I would argue that you can never actually get to completely fair. However, in the the blockchain space, we find all of that kind of level of supervision unacceptable, right? The thing either works or it doesn't, and it should kind of support itself, right? There's a culture of code is law, meaning that the contracts that exist on these blockchains, the algorithms that they employ should be good enough that you only have to put your trust in the thing that's written, and you don't have to trust some supervisor or authority to ensure that it's working correctly. And in a sense, the markets on Bancor, but also other dexes, right? Like SushiSwap, Uniswap, the fact that it is so thoroughly crowdsourced in most cases, it means that no one actually has sufficient resources to determine the outcome or influence the market in a really profound way. There is still some, players in the space that are able to control the cryptocurrency markets or influence the cryptocurrency markets in a way that is, let's say, unhelpful. The DEXs and protocols like ours are really helping, I think, to blunten the tools that these centralized authorities in cryptocurrency used to have. So in general, it's a very positive influence in the space, and I think it's going to keep getting
and philosophically, I think it's really interesting, right? Because like the reason that it's difficult to become a financial institution is because you do have to trust so much. And so regulation is the enforcement of that trust through a system of constraints, right? Where those system of constraints are human-based. Like most regulatory things, like some of it is technology, but actually most of it is just process-orientated. Like which person's allowed to sign this thing? Like how many layers does it have to go through to do that? And that's why the regulator prefers to have fewer financial institutions, higher regulatory like rule sets, because it's actually quite difficult to create these, and it's difficult to actually create a set that you can be guaranteed is going to work, and often it doesn't. Like people just find loopholes. Humans are humans, right? Whereas you sort of completely abrogate that in with smart contracts. You have this ability to say, right, this contract is the entity that is controlling the funds, and we can create a set of rules, a set of constraints for which those funds operate. And so we can get rid of huge amounts of this sort of like process orientated approach. This is a regulatory control approach to creating trust, because you're able to create trust just by dint of creating these smart contracts. The other thing that I think is really interesting, and you are harking back to it, is that, like back in the day, there was this, when the internet came along, there was this revolution of people going, oh, well, we can offer this low cost from an operations point of view, you don't have to have the branches, etc., way of giving savings accounts to people. And that's where ING Direct and things like that came out of. What I think a lot of people don't realize is that what we're describing with what Bancor is doing is actually a lot of what the banks already do. They take these deposits, and they take the deposits from people, and they use those deposits to provide different types of liquidity to the market, both from the point of view of borrowing, but often from the point of view of forex and market facilitation. Right. And all we're doing, all that's happening in DeFi is we're creating these systems that are able to do that automatically.
Correct. And I think, on that note as well, I would like to point out that the regulatory influence in banks and things is often a positive thing, in the sense that if someone is offering, like a high interest online saver account or something like that, that governments insist that they have assurances that the customer is going to be able to withdraw the value of the funds that they were expecting. And in DeFi, because it's relatively unregulated, that kind of assurance isn't enforced. And so for a lot of our competitors' protocols, you can deposit money into it, and they can say, this is what the expected ROI is, but there's actually an element of risk there. That means that you actually could withdraw slightly less than not just than what you were expecting, but actually slightly less than you deposited in the first place. On Bancor, we don't want that, right? We really are trying to emulate the regulated space. And so the protocol itself provides that assurance. It has the ability to guarantee that customers' funds or the total value of customers' funds will be available when they withdraw, and that's something that's unique to us, and that's something that we've only had for the last year.
Right. So let's talk about that, because I think that I think some people are quite familiar with like the continuous function automated market maker, things like Uniswap and SushiSwap, where it's sort of a brutally simple idea where you go, okay, I have two pools of assets, and the ratio of the number of assets in both of those pools is what gives you the exchange rate. And so if I want to create a liquidity pool in DeFi on SushiSwap between USDC and Ethereum, I provide those assets and I have to provide both sides. And to do that, once I've done that, the liquidity of the market is defined by the total number of assets in both sides of the pool, and the price that you can buy one for the other is determined by the ratio. And as a result, it's super, super simple, but has driven a lot of DeFi liquidity. Bancor is unique in this ability to only provide one side of the market. So I'd love you to talk a little bit more about like how that works.
Yeah. So what you've described is essentially the fact that if you're providing liquidity on something like SushiSwap or Uniswap, that they require you to hold at least some minimum portfolio, right? Where if you want 100% exposure to just one asset, they're like, I'm sorry, you can't do that because the pool requires you to fund both sides. This is a huge problem for actually a very large number of reasons. One is that it actually puts, I would say, undue stress on whatever assets that Uniswap considers to be the base, right? So on Ethereum, they want ETH to be the base asset, but that raises an interesting question as to whether or not that's going to be true on every blockchain or every layer 2, and if that is going to be sustainable across all of those chains, because ETH already is about to experience a huge amount of staking demand due to things like Beacon Chain, where you can earn interest, and if that interest is competitive with market making, then some of these pools could dry up, for example. For Bancor, the BNT token was designed exclusively to fulfill that role of being the base token, right? The thing that acts as conduit, the global numeraire, if you like, for the exchange between any of those tokens, and it will be that on all of the chains that Bancor is deployed on. What's interesting about this is that since October of 2020, the protocol has had the ability to create and destroy BNT as it's required. So this is a price neutral supply shift. So it can mint BNT in order to match the other side of the pool when a user is depositing the tokens that they prefer. And so this means that Bancor's liquidity providers have the flexibility to maintain whatever portfolio exposure they wish. If they want to have 100% of their exposure in Chainlink, they're absolutely free to do that. If they want to have 70% Chainlink, 30% USDC or Bitcoin or whatever, they can provide liquidity with all of it, and the protocol itself will provide the BNT on the other side. This is extremely helpful because it means that one, the TVL on the network isn't at all bound up in the economics of another project's token, and I would consider Ethereum to be another project's token. And two, it means that the protocol can scale as much as it wants, right? We're not dependent on the availability of another token. But that elastic supply, the ability of the protocol to create and destroy BNT, it's not just the thing that supports the single-sided liquidity provision, but it's also going to power a bunch of features that are coming out with our version 3, and it also powers the assurances that we were discussing before, which we call impermanent loss protection.
Right. So there's like a few like huge advantages here. One of which is that I suppose if I think about it in a really like simplistic term, it's sort of a little bit like Uniswap V1 in that everything that Uniswap V1 was against ETH, because the principle was if everything's against ETH, then I can always go through to something else, because if I've got BTC versus ETH and USDC versus ETH, and then I can do in a single trade atomically, I can go USDC, ETH, BTC, and then at the end of it, as a user, I've gone from ETH to from USDC to BTC, but from the routing, I've gone via ETH. And what you're doing here is you're going, all right, we can do that all against BNT. So now everything is against the Bancor token, but we're not going to require anyone to deposit, unlike in Uniswap V1, where you had to deposit both sides of it. We're not going to require people to deposit BNT. What we're going to do is we're going to go, if you deposit Chainlink or ETH or USDC, we will deposit the correct amount to create the correct ratio on the other side. And now that trading can occur, which I suppose is also why there's this impermanent loss protection, because you're like, if an asset goes parabolic, the price increases very quickly. Your exposure. So actually talk about that. How if the price of, let's say, the price of ETH goes parabolic, how does the user end up with the same number of assets at the end of it if people are trading out of it over the price increase?
Yeah, so the best way to think about it is that the user's portfolio value is the thing that's being guaranteed. The actual composition of that portfolio will change dynamically as, for example, the price of things moves around. So in the case that you have proposed, where someone provides ETH and ETH goes parabolic, let's say it goes 4x versus BNT. Mm-hmm. Then that means
you heard it here for her first. 4x ETH.
Then in that case, the pool will be running out of ETH compared to the user's deposits,
right?
By a rate of about 50%. And so at the time that you choose to withdraw, it's actually a rather trivial calculation for the pool to perform that says, okay, if they did have all of the ETH that they provided at this point in time, then it would be worth this total amount. And then it has a look to see, one, if the protocol can provide that ETH back to the user. So in general, as long as you're not like a huge whale or something, when a user is withdrawing, the protocol will have actually garnered its own ETH for itself during the trading activities as things are going parabolic. So the first thing it will check is whether or not the protocol can liquidate its own position in order to refund the liquidity provided, the ETH that they're due. And most of the time, the protocol is able to cover, all modest withdrawals, even when something has gone parabolic, as you say. But then when things go ballistic, right, like Matic did during 2021, those kinds of impermanent loss events can be quite catastrophic, and there just isn't sufficient Matic belonging to the protocol in order to refund the user. And so in that case, the protocol will give up its BNT side of the pool in order to give the user the value that they are entitled to. And if there's any delta there, right, if there's even 1% that the protocol didn't already have to make sure that the user receives all of the funds that they're entitled to, it will actually create additional BNT in order to give the user what they were expecting. So after that, the user can then swap the BNT that they get back from Matic, and an arbitrageur will close that, and we end up back at square one.
Understood. So like that I suppose is one of the main drawbacks, is that the impermanent loss protection insurance payout is in value rather than in kind in the case of the worst impermanent loss.
And the word insurance is really important, because often, the thing that you insure, you don't give the policyholder that thing, you give them the value of that thing.
Right.
So for example, if you've got an insurance policy on your car. I know that there are some insurance options that actually will provide you a new car if it crashes, but usually what will happen is you actually just get a cash payout. Right. And then it's up to you whether or not you want to spend that money on a new car or just keep the money. Right. And so that's similar. Like we've actually had users that when they withdrew, it's not necessarily a good assumption that they always will swap their BNT for the asset that was missing, because often, think about this psychologically for a moment. If someone is withdrawing from a position, it's usually because they want to exit that position. Right. And so receiving another token, they're like, oh, that's interesting. Maybe I want to speculate on this for a little while. So in the beginning, I've had to monitor this kind of stuff pretty closely. And I was paying very close attention to user behavior. And it's only like about 50% of users that actually decide that they don't want the BNT that they were paid out in, which is interesting. It's a much, much lower number than I was expecting. I was expecting like 99% of users would swap it immediately. And it's just not true.
I suppose it's really interesting, right? Because you only pay, the insurance only is required to pay out in the case that you actually need to withdraw. And if something has gone parabolic, a lot of the time you'll be taking a profit. You'll be looking to do a profit realization on that because you're like, oh, it's gone parabolic. As a result of it going parabolic, I think it's probably done as much growth as it's expected to do.
Yeah, it's due for a pullback or something.
Right, it's due for a pullback. I'm going to take some profit. Sure, I've got paid out in BNT, but the BNT is the value of what I would have had in Matic if I'd held it, plus the fees that I've got. And now I can go and trade that for USDC or whatever else it is that I want. That's really interesting. So let's pull back a bit and talk a little bit about the sort of the history of Bancor. Bancor was one of the earliest DeFi projects. We didn't even call it DeFi then, right? We just called it. We
were before, yeah. We were on chain before Maker was, right?
So on chain really before Maker, yeah.
Yeah, this is like the word DeFi hadn't been coined. Yeah.
I remember the controversy around Bancor. It was so funny because people were like, because you guys raised a lot of money. Was it like 100 million or something like that?
157 million, yeah.
157 million. So you guys raised 157 million in 2 hours. This is one particular point of the Ethereum history where Ethereum had gone up a lot. There was a lot of capital around. There was a few projects who sort of really got it. Bancor was one of them. You guys did this fantastic token sale. You got 157 million. And I can remember people being like, what do you guys need 157 million for? And there was all of this anger about how much money you had taken from the market. And now projects routinely raise sort of like that sort of number, and people are like, oh yeah, that's a normal raise. So it's funny how the space has changed so much since then. But talk a little bit about where Bancor came from and what the origination of the idea was.
Yeah, certainly. So let's back up a little bit, because the ICO raise for Bancor was kind of in the midst of the project's early development. And actually, the Bancor project itself, it actually came from a place of wanting to create community currencies. This is back when Bernard Lietaer was our chief economist. For listeners who don't know, Bernard Lietaer was one of the co-creators of the euro. And so he was on the Bancor board, and he was one of the people that was extremely vocally in support of the idea that having as few currencies as the world currently has is a really bad idea, and that fiat is likely to be permanently unstable and unlikely to support the world's economies. And so
true Austrian competing currencies, sort of
complete anarchist. Yeah. And so, he was a very strong spokesperson for cryptocurrency in general. I think he saw a lot of value in the idea that people could pick and choose which cryptocurrencies they want to represent their wealth, and also which cryptocurrencies they want to trade in. And so Bancor started off as a community currency project. There were a few key places chosen representing, I suppose, different pain points and where the use case of a community cryptocurrency could really be experimented with. So there are a couple of communities in Africa where, because a lot of the a lot of the fiat currencies in Africa have completely collapsed. And so having a community currency there would be an interesting use case.
Can you just define a community currency? What's a community currency?
Yeah, a community currency is essentially it's a community's own fiat, right? It's the idea of if you're going to the hairdresser or something, rather than giving the hairdresser the currency that the government has issued, you give them a currency that the community agrees on and can use to adjust the price of things. So
and how big or small are we talking here? Are we talking like the Guild of Hairdressers currency, or are we talking Manchester coin?
Yeah, kind of like Manchester coin. Yeah, like a little city economy, basically. So, buy fruit and vegetables, pay for labor, that kind of thing. So, yeah, usually, I can't remember. I wasn't a part of the Bancor team at that time. But yeah, it was small-ish sort of scale, certainly nothing the size of Manchester, but that was the idea, right? That each city could have its own cryptocurrency. And it wasn't just communities in Africa either. I think there were a handful of towns chosen in North America that were also using cryptocurrencies that were working quite well. It was an actual scale experiment, and it did work extremely well within those communities, honestly, like as well as dollars do, for example. Like no one really cares about, no one thinks about the value of a dollar when they spend it, right? They know its relative value. Like if you're buying bread or something, the only reason you know that what bread is cheap and what bread is expensive is because you have this kind of frame of reference for what else you could spend that money on.
Right.
And so within a community, there was no problem. The problem is that once these bubbles started to interact with each other, it was impossible to know the value of each other's community currencies. They had no exchange rate.
Right.
And that's really where the beginning of the DEX idea started. One of the Bancor founders, Eyal Herzog, had this idea for the bonding curve. Some of Bancor's original research, especially with Simon de la Rouvier, Udi Levi, who's now a CTO, really described how these bonding curves could operate, and in particular, the idea of having an accounting system for tracking what is the pro rata ownership of this pool of assets that at the time was called, I think, a relay token, and then it became a smart token for marketing, and now everyone just calls it a pool token. So those were kind of the two major innovations that were required. Like, how do you get an automatic exchange rate between community currencies, and how do you fund that and make markets with it and keep track of who owns what? And so that's what sort of the ICO was kind of revolved around, is how to build this.
Was this 2016?
2016, 2017, yeah.
2016, 2017. Super interesting. Yeah. So like you guys, like this is, I think there's a truism in crypto, which is like everything that everyone has imagined will eventually come true. It's just a question of when, not if. Like, and you can. And it's quite common for teams, especially in early industries, to imagine futures that they think are closer than they actually are in reality. But like this idea of community coins, like Miami Coin, is playing that out in a way that is different from how it was imagined it was going to be. But like the concept of it is still, this is a community coin that can be useful because you can control your own monetary policy. You can decide as a community how it's administered, and you can actually build revenue streams out of it that can help pay for stuff that the community cares about. And I think, there are experiments increasingly at larger scale that a lot of people back in 2016 would be like, you guys are crazy. And now we're like, well, no, we're not. We're just like, it was just really early for what we were thinking it was eventually going to go. And then what often happens then is you go, well, we need a bunch of enabling technology. We need to be able to focus in on a certain thing. So like the concept of the bonding curve, people don't know that Bancor came up with that. Like that wasn't Uniswap, that was Bancor. And the concept of pools and like asset pools that you could add, that was Bancor as well. You guys paved the way to so much fundamental research that sort of like created was put out there and helped create what DeFi is today, and I think is super impressive.
Yeah, and one of the things I want to discuss as well is that when we arrived there, because DeFi wasn't its own thing yet, right? It didn't have a culture associated with it. There wasn't this kind of separatist movement yet, if I can call it that, where we were trying to distinguish ourselves from traditional finance or something. That line in the sand just hadn't been drawn, and so it was just finance, right? And so that money that was raised from the ICO was used to create something called the Bancor Foundation, which is a Swiss nonprofit that works to support the Bancor protocol and pays staff salaries and, most importantly at that time, lawyers' fees, because at the time we were told Bancor is just an exchange and you're going to have to regulate it like an exchange. And so it was a smart contract controlled and decentralized or partially decentralized version of like Bitfinex at the time,
right?
But it was held to all the same standards.
The custody was decentralized, but the identity basis in which you could exchange in the first place had to comply with regulation.
Yeah, exactly. From a legal liability standpoint, it was just an exchange, and that meant that the pools weren't permissionless, right? So if you wanted to create a pool on Bancor in those days, you had to send us an email, and we would send you the forms, right, for people to sign so that we could create the thing for you. And we were literally told that you have to do this. And I think, we really did take a leaf out of the Uniswap playbook when they came sort of bursting out of the gates. And we're ignoring all of that, saying anyone can create a pool. And what was mind blowing to us is that we were told very stringently, you cannot say anything about the fee earning potential of providing liquidity, because now you're getting really deep into securitization laws, and that's going to be a nightmare that you want to avoid. And remember, at the time, that there were a bunch of ambulance chases that took Bancor to court through the United States legal system that we had to defend ourselves out of after the ICO era as well. So we went through all of this phase. We were super conservative legally. We won all those cases with BNT, and BNT was declared a non-security by FINMA, recognized as a non-security by the SEC, at least by precedent. And that meant that we were able to, for the first time, to open up the app to US customers. And so, we really did all the stuff that people are terrified of with the new regulatory talk. We've already done that. Like 2017 to 2020 was just that. So no matter how bad it gets,
and it's hard. It's really hard, and it's
super expensive. Yeah,
and you get zero thanks for it as well, from the point of view of the community.
Exactly. Yeah, it's super stressful, and so no matter how bad things get from a regulatory standpoint, I'm convinced that we'll never get as bad as what's already happened.
Right.
And so I'm glad that that sort of part of our history is over, and I do want to acknowledge Uniswap for showing us that you can be brave and just open it up and see what happens, and spur those conversations with regulators in a more productive way. Because if we just carried on the way that we were, I don't think DeFi would be what it is today. So yeah, that was what we did with version 1, and then shortly thereafter, we released something called version 2, which was the first time that the idea of concentrated liquidity, or we called it liquidity amplification, had been considered, which is this idea that you can change the capital efficiency of a bonding curve by over-representing the assets that are there. So, they make a $100,000 pool of capital behave like a $1 million pool of capital just by 10xing, the amount of tokens that the pool reports to the trader when they're trading with it. This system has problems because if you are trading at that level of efficiency, it's possible for the pool to run out of liquidity on one side.
Right.
If a trader drives the price off of out of one of those axes, then the pool no longer has that resource, and trading essentially ceases, which is very it's worthwhile trying. Not optimal. You want to avoid that. That means you're capital efficient, but for very short periods of time. And so
it's like the nitrous button on a car.
Yeah,
it's like it's great for a short
exactly,
period.
yeah. And so our workaround for this was that we introduced a piece of chain-link technology that would essentially shift the dynamic weights around. So it effectively allowed the pool to always operate as a deeper pool, but the bonding curve would kind of bend and warp as traders interacted with it, which sounded really good. And it also meant that impermanent loss would essentially be a thing of the past, right? Because we could create arbitrage opportunities that would cause assets to kind of come back into the pool. And this system, it's one of the most, academically speaking, I think it's one of the strongest AMMs ever created. But in practice, it was a disaster. And the reason is the adversarial nature of Ethereum, right? Once people know how these algorithms operate, they can figure out how to make them do things that they weren't necessarily designed to do.
Right.
And because Bancor was offering, this impermanent loss insurance and,
right.
bore that obligation on behalf of the liquidity provider to protect their funds,
right.
This was unsustainable, right? You lose money hand over fist.
Mm-hmm.
This idea has been iterated on by Dan Robinson and Hayden Adams at Uniswap, and they have a slightly different version. So the Uniswap V3 uses tick values, and they basically, by not wearing that responsibility, they actually can achieve really good capital efficiency because the liquidity provider, if they're getting wiped out or something, it doesn't matter because
because they're not taking the other side. They're just like, hey, like you now have 100% one asset and not the other. Both of them are your asset.
Exactly right. And so, it's like when you're in range, you're a liquidity provider. When you're out of range, it was a limit order. But it's a really interesting design. We're laughing about it, but Uniswap V3 is, again, academically speaking, it's quite beautiful. It's obviously working very well. I was excited to see.
It's incredibly elegant. I think it's one of the things that I most admire about DeFi is their ability to take brutal simplicity to an art form. You create a feature that now ends up having 5 different outcomes that can be used, but it's just the same feature. Like, as you say, it's a limit order if used in a concentrated enough form, or outside of out of range, so that when it comes into range, it's a limit buy order, or below range, a limit sell order. Like, all of this stuff is very, very powerful, but it's also like super. It's taking DeFi primitives and applying them in a way that finance doesn't, because finance doesn't need to. Finance can be more complex because you have an unlimited amount of technology that you can throw at a problem, whereas in DeFi, you have a very limited amount of computing power and a very limited scope for which something can process something. And so you have to be more brutally simple in how you create stuff. And I love Uniswap V3. I think it's very elegant. It's also quite complicated to understand, which is its main downfall, but it's very elegant.
So I think I'm in the excellent position, right, of actually having studied Uniswap V3 very, very thoroughly now, because we're producing a research paper on the IL consequences of their concentrated liquidity model. Because it is a little misleading, I think, when basically when users go to Uniswap V3, they see these huge transaction volumes and all the fees that are accumulating, and they miss this cost, right? That by concentrating the liquidity, you're actually selling your tokens at a discount to traders, and then especially to arbitrageurs all the time. And so we've been analyzing the profitability, not because we're antagonists necessarily, but because we're interested in following all of these models, right? We also have, internal documents for analyzing Curve V2, which is another kind of concentrated liquidity, and we analyze everything. And it turns out
I hate the Curve all of the curve papers are like the most frustrating things to read in the because like I feel like he's made his maths purposefully difficult to understand. I'm
Yeah,
like,
well, the original, yeah, it's interesting you say that because the original augmentation that he made to the bonding curve, right, which he called the stable swap invariant,
mhm, mhm.
it actually has no symbolic solutions. You can
Right.
only
I was I'm glad that you said that because I sat there looking at it for like a couple of hours and being like, am I stupid? Or is
no, no,
this
no.
actually
Yeah, you have to solve it numerically, which is interesting
right,
because it has gas consequences and things like that.
right.
But yeah, no, the point is we study everything, and Uniswap V3 for all of its elegance and power, its profitability is definitely questionable. And that's not to say that people aren't making profits, because there are those that are making profits. But there's kind of this bed of skeletons underneath that for people that are basically kind of what you were saying. I think what you were trying to say before is when Uniswap V3 was developed and designed, I think they had a very specific user base in mind. And it's these sophisticated, highly active, high frequency trader type individuals who understand about, risk and how to hedge and,
Right.
tracking market movements very carefully. But the existing Uniswap user base was predominantly this kind of lazy retail investor who was just trying to earn some passive yield on their thing. And so I think that with Bancor version 2.1 and with Uniswap V3, it kind of there's this like bifurcation of strategy in approaching different demographics. And I think the Uniswap V3 will continue to appeal to these kinds of sophisticated individuals. And the Bancor version 2.1 product is more for that, online banking type customer. And with our Bancor version. And so, yeah, the point that I'm making is that while Uniswap is going for efficiency at all costs, which, another way of saying that in finance is as much leverage as possible. And, concentrating the risk, but also concentrating the potential profitability, but also the losses. Bancor is the other thing, right? We're doing the risk off thing, the stable thing, the slow moving thing, right? Whereas if Uniswap is kind of like the IndyCar of DeFi, I want Bancor to be the tank, right? The thing that is immovably massive and that has this this resilience against market effects, where people aren't getting wiped out, and that can kind of be the stabilizing force in the DeFi economy. I'm actually presenting a talk later this week, virtually at a Swiss conference, where I will be comparing the strategy that Bancor is employing to this exchange in New York. Their major innovation was to add like 20 kilometers of fiber optic cable to the lobby in order to introduce a time delay, right? And that's kind of what we are, right? We're not going to do, like, we've done the concentrated liquidity thing, and we know how devastating it can be, right? And because we have an obligation to try and protect users' funds, we don't want to introduce that level of risk. We're going to find other ways to be profitable. And what's interesting is that, there's there was a Nobel Prize awarded for something called the leverage, or it's basically it's Modigliani theorem, which states that it doesn't really matter how a company's capital is structured, right, with regards to its leverage, the overall profitability is likely to be the same. And I think that's what we're seeing on Uniswap V3, right? It doesn't matter how much you concentrate the liquidity, the risk kind of offsets the thing. There's no free lunch. And so we can be the slow moving thing, and have everyone sort of earning the safe passive income, and on average be just as profitable as the Uniswap protocol is overall. But if you have a look at individual users of Uni V3, there are going to be people that have huge profits, but then there are people that also have
your variance is going to be higher. Your variance of returns is going to be higher on Uniswap V3, which, like, for the crypto audience, is actually probably going to play better for a while, because the crypto audience love to celebrate people who make like 100x in a day, right, or 1000x in a week, but like not talk about the people who like got wrecked. And I think this sort of like stable approach approach to providing predictable yield to people is the long-term battle for that is, I always talk about this, but fundamentally DeFi's battleground is the battle for consumer deposits, and the battle for consumer deposits is not going to be played in the sort of like complex high frequency area. The complex high frequency area will turn those consumer deposits into market facilitation, but like from a consumer point of view, it has to be as simple as possible, and it has to be as risk-free as possible, or as low risk as you can make it, given the constraints of the market and whatever the exposure that the user is choosing to put themselves through. So yeah, it's just a really interesting approach, and I think you guys have had an incredible longevity in the space, and it's going to be amazing to see how you continue to progress over the sort of the next few years. And I'd love when Bancor V3 is out to have you back on to talk about that as well.
That'd be wonderful. There's a lot of super exciting stuff that I will be very. I'll be very interested in pursuing conversations about after V3 is released. I'm currently under a gag order, so I can't discuss anything at the moment. But we just recently on the last community call said that that gag order is going to be lifted on the 28th of November. So that's when we're going to be discussing version 3 with our community in depth. It's not its launch date though, because it's hard to anticipate how long audits and things are taking. But the 28th of November is not it's not an incidental date. This is the day before the Decentral conference in Miami, and so we'll be presenting, talking about these concepts with our community first via an online event, and then I'll be presenting it, sort of unveiling the V3 theory at Miami. So if anyone is around, come and say hello. I'll be there. And I think it's going to be a really terrific event.
Awesome. Mark, it's been such a pleasure having you on. If people want to get some more information about Bancor or get started with the protocol, where did they go?
Yeah, so the best place to go is directly to the app, which is just app.bancor.network. And on Twitter, the main account is just @Bancor. And then, that is generally enough information to get well connected. We also have Telegram channels. In fact, I would say the Telegram community is among the most active. There is 2 channels, the Bancor liquidity providers, which is kind of the more community-centric channel. That one is the, price discussion is okay. It's not moderated very, very closely. And so that's actually Bancor traders. So t.me/Bancor traders before version 2.1. And then the main Bancor protocol channel is t.me/Bancor. We also have a Discord, but that's a lot less popular, and the admins inside the Telegram channel or Twitter will be able to direct you to those links to get admission.
Thank you very much, Mark.
My pleasure, Piers.